Hello and welcome to CFRA Insights, where we explore the investment themes shaping tomorrow's market opportunities. My name is Aniket Ullal, and I head up ETF Research at CFRA. And I'm joined today by my colleague Stewart Glickman, who's a Director of Research and also heads up our energy sector research. Welcome, Stu.
Hey, Aniket, thanks for having me.
Yeah, great to have you join this discussion. Let's start with the big news of the last couple of weeks in the energy sector. We saw recently the United Arab Emirates, the UAE, announcing that it's going to exit OPEC, which is the large oil cartel. So, just wanted to get your views on how big an event is this, and what impact you see this having on global oil production volumes.
Yeah, Aniket, so I'd say on paper, it's a pretty big impact. UAE is the third largest producer in what had been the OPEC cartel, just after Saudi Arabia and Iraq. So losing call it 3.65 million barrels a day from the cartel would be meaningful. The thing to keep in mind is that it's really sort of an on paper event at the moment because the UAE depends, at least to some degree, on moving its production through the Persian Gulf, which means going past the Strait of Hormuz, which of course at the moment is a bit constrained. So I think it has probably a bigger impact next year than it does this year.
I think that's an important point. Obviously, we don't know at this point, given when we're recording this, what's going to happen in the Strait of Hormuz, but certainly it continues to be a choke point. So it sounds like from what you're describing, you expect oil prices to continue to be elevated in 2026, but I think you're projecting quite a sharp fall in 2027, given, as you mentioned, UAE could come back online with more production. We could see some demand fall off from higher prices. So I'm wondering, the other related thing is we recently downgraded energy from market weight to underweight in our sector outlook. So could you talk about these two things, how they're related, and what drove some of the decisions for us to downgrade energy?
Yeah, so it's a good question. It's a couple of things. On the one hand, we are expecting that getting things unbroken in the Strait of Hormuz is going to take some time. In the interim, oil prices are probably going to remain elevated. And when you have oil prices like WTI, for example, today, May 12th, is trading a little over $100 a barrel. I think it's 101 the last time I looked. When you get oil prices in that three-digit range, it can have an adverse effect on global economies. So I'm concerned that for 2027, that oil prices indeed are going to suffer. The UAE exiting OPEC just adds more fuel to that fire, where you might have next year a combination of, a weakened economy because oil prices take a toll later this year, combined with too much supply, does have an adverse impact on oil prices. So we're calling for oil to be around $100 a barrel this year, probably something like the low 60s in 2027. And in that kind of environment, where you're valuing energy companies on the basis of 2027, that was part of our rationale for downgrading the sector on April 2nd to underweight. At that time, the energy sector was trading at about 25% above its historical forward average, which we didn't think made a whole lot of sense when we're concerned about prospects for 27.
Great. Let's just talk about some energy sector ETFs, because obviously we know ETFs is one way that investors access various sectors and themes and groups of stocks. We know that XLE, which is kind of the most popular sector ETF, it's the State Street sector, energy sector ETF, has actually been flat in the last month. So that quite aligns quite nicely with your call to downgrade energy. We need to watch and see what happens there. Are there other ETFs that you like? I know you've been more bullish or optimistic about downstream energy, particularly refining. So can you talk a little bit about any ETFs that you like in that space?
Yeah, so refining is an area that we like relatively better. Refiners tend to prosper when spreads blow out. And so, for example, the spread between Brent and WTI has widened considerably. Normally around $4 a barrel, maybe $3.50 a barrel. Brent a little bit more expensive than WTI, but that spread has widened. and that tends to drive higher margins for refiners. We think this is a consequence in part of the congestion in the Strait of Hormuz. And so if you look at an ETF like CRAK, C-R-A-K, the Van Eck downstream ETF, we have buy opinions on three independent downstream refiners that are in the top 10 components of CRAK. Marathon Petroleum, HF Sinclair, Valero Energy, all top 10 participants in that ETF. So we like CRAK at the moment.
That's great. I think this really highlights how it's important to focus not just on the headlines, but really look at the underlying holdings, look at which sectors or industries within a sector and how they're going to do going forward. The regular listeners of our content and those who access our research will know that CFRA publishes ETF ratings for US equity and bond ETFs. And the ratings too are quite consistent with what you mentioned. We currently have a 1-star on XLE and a 4-star on CRAK. So I think that aligns well with some of our broader sector views. So Stu, again, thank you for joining me. And for those of you who would like to access more of CFRA's insights, go to cfraresearch.com or advisor.marketscope.com. Thank you for listening.